Good evening. I am Shirvan Joseph. I am a diversity outreach manager and mortgage loan officer with Fitzgerald Financial, a division of Town Bank Mortgage. Um, our job is to bring you an enhanced version of qualifying for a mortgage and to prepare you with credit aspects of your credit report, how to enhance your credit score, how to prepare you from a qualification standpoint, and ensure that you're prepared for purchasing a home. Uh, if you recent numbers, if you look at the numbers from the U.S. Census Bureau, uh, the percentage of home ownership still has a very alarming disparity. White borrowers at 74, 75% home ownership. Black borrowers are at a 42 to 43% home ownership rate. That's a huge disparity. And the only way we could combat that and enhance the experience of closing that gap is to ensure that we communicate through literacy training and making sure you receive accurate information that's going to put you in the right place as far as ensuring that you get to the finish line. I am with a company that's fortunate enough to allow me to do these seminars and my podcast, Shirvan Speaks, which is on Spotify, allows us to convey this message to you. And along with myself, Sean Higgins also participates in these seminars, and he's a executive vice president with United One Resources, which is our credit entity that helps us with all our credit reporting and so forth. So anytime we have to use a credit reporting mechanism, it comes through Sean's entity. And so Sean will do the first 15 minutes of our presentation. And in 15 to 20 minutes, he will talk to you everything about your credit score, how to increase your credit score, and a lot of factors that you might not know about your credit score. After that 15 minutes, I will come in and do the rest of the presentation on how to qualify for mortgage, what programs might be available to you. It'll be a condensed version, and we will give you information where you can contact either one of us if you wish to get a mortgage or wish to be pre-qualified. I'm always available. As everyone knows that's in the industry, I work pretty much 24/7. I've been in the industry for about 38 years. I've held just about every position from mortgage loan officer to branch manager to area manager to division manager. And now I'm a diversity outreach manager, and I am still a mortgage loan officer, which I love being a mortgage loan officer because I get to participate in the biggest investment of people's lives. And, that's how you start your wealth. That's where we grow wealth. That's where we want the community to understand wealth starts with the great credit that you have onto being able to purchase a home. So anything that we could do to start that process, we're all in for. Now, Sean has been in the industry for over 31 years in the credit industry. He's going to speak on himself. He's very capable of talking about himself, and he's a whiz at anything credit. That's why I love for him to do it, do what he does. Nonetheless, without babbling any further, I'm going to give you Sean so we could start it off with the credit piece.
Thanks, Shirvan. Everybody, it's nice to meet you. I appreciate the opportunity to come in and speak to you tonight. One of the things that I'd like to establish right up front is we're not a credit repair agency. We are a credit reporting company that's fortunate to provide services to Shirvan's company. Along the way, what we also do is we have a score simulator that allows us to provide opportunities to improve scores. So one of the things that I'm going to do tonight is hopefully provide you with great insight as to how the credit scoring process works, how the credit reporting process works, and it'll dovetail into what Shirvan will be talking about as far as the mortgage. So on the screen that you see right now, my contact information is there. It'll provide you with a way to reach me should you need to. I always encourage people to reach out to the lender. That in this case, it's Shirvan, because most of the credit activity starts with the lender and moves its way through. One of the things that you should know is if you're dealing with a lender like Shirvan, he's very well versed in a lot of the things that we're going to talk about. So you will get probably the best service and superior knowledge in dealing with Shirvan on the items that we're going to talk about tonight. Okay, so let's move through it. So credit scoring is really what the most important thing that happens in the mortgage process as it relates to your credit report. I like to tell people that a credit score, quite honestly, the best way to describe it is it's like a stopwatch. It's a moment in time in which all three credit bureau reports on the applicant, which is there's a file at Experian, Equifax, and TransUnion. Those reports are accessed and a score is appended. When that score gets appended, that's your credit score. There will be some timing differences on the credit reports as far as the information that's on them. Different credit grantors report the information at different times throughout the month. So there'll be a little bit of an unevenness in the process as far as the content of the report and the scores that it's delivered. A lot of people have good knowledge on how credit scores work right now. It's a very populist topic, and in the mortgage business, we currently use a FICO score version 8. So that's important to know, because as you get further into this presentation, you're going to see that there's different types of credit scores that are out there. But the most important thing to remember in our process, and that's for the mortgage that we're talking about, it's FICO score version 8. You're probably going to also hear me say a term tonight that's called credit fitness. And when I got in this business 32 years ago, not a lot of people understood how their credit score was calculated. Not a lot of people understood what their credit report contained or any of those things. So now it's very, very popular amongst people to discuss their credit scores and have a really good understanding of what's in their credit file. So credit fitness is just a little term that I use in my presentation so that people get a feel for what's actually going on with their credit report. So let's move on to the next slide. So let's start with the very basics. Credit score ranges. They range from a 300 to an 850. And quite honestly, anything that's a score above a 700 is an excellent score. We work as a provider of credit reports and also as a provider of score simulation to see where there's opportunities to improve the scores. So we generally get involved with a client, a lender client, when they may have someone that may be at a score of like say 580 and above, and they're looking for improvement in the score process. We'll talk a little bit more about that, but FICO, who actually makes the score calculations, is a very well-known company in the business, provides this slide. So you can see 300 to 850, and there's the different factors that, or I should say, the different labels that are put on the different score ranges. The most important thing to remember about this part of the presentation is credit scores can be improved. It's not a forever thing. It's very, very important for everybody to understand that whatever your score is right now, it can be improved. Okay, let's go to the next one. So how are credit scores calculated? There's a couple of different factors. There's an amount owed, which I'll spend probably a little bit more time on that. Payment history, that's pretty much just common sense. How well you are paying your debts and how well you're handling them. Obviously, if you got some lates, there's going to be some bumps and bruises that'll occur to your credit score because of that. The other three factors, which are new credit, length of the credit history, and credit mix, they have a little bit less of an impact in your score calculation. However, if you have a very thin credit file, which means that you don't have a lot of credit trade lines, they'll have a little bit more of an impact. The one that we focus on the most is going to be the amounts owed. And the term that they use in lending is utilization. And utilization is very important as it relates to your credit cards. Okay, so credit cards are effectively also known as revolving debts. So if you could keep your revolving debts to below 30% of the available credit, you're maximizing your score. And quite honestly, that's our secret sauce as far as improving scores. If we look at a credit file and we see different things out there as far as balances that are a little bit higher than the 30%, we look for an opportunity to reduce those balances through a payment and then seek an opportunity to improve the score. I'll talk some more about that as we get into it, but that and making payments on time, they're the two biggest drivers of a credit score. Okay, let's go to the next slide. So how does it all start? Okay, so it's a credit inquiry. So if a consumer goes and makes a mortgage application or a car loan application or whatever kind of credit application it is, that's considered to be a hard inquiry. Okay, hard inquiries it's part of the mortgage process. That's the credit report access that the mortgage lender uses, hard inquiries. There's another type of an inquiry out there that's called a soft inquiry. Okay, and the most recognizable use of a soft inquiry is going to be if you have an existing account relationship. Say, for instance, it's your credit card, and your credit card provider wants to see how you're paying your bills or how your credit score is performing. They have the right to do that once a year, and it's usually in one of those million lines that are on your application. I'm sorry, on your agreement for having that credit card. So, difference between the two of them is it's just the way it's posted to your credit file. The thing to remember about these inquiries is they both look at the same type of data. They both use the same score ranges. It's just how it's posted to the consumer's file. Okay, let's go to the next one. So there's I call them myths. There's a lot of myths that exist out there as far as and it happens once in a while when a mortgage lender wants to take an application from a consumer. Sometimes people will put up a little bit of a concern. They'll say, well, I'm not really interested in having my credit report pulled. And Shirvan will tell you when he does his presentation that they really can't do much without that. And, when you push back and you ask why, they'll say, well, it's going to have a negative impact on my credit score. Here's the truth. The whole process can't work without a credit inquiry. 5 points is the impact to your credit score, and it usually takes about 30 days, okay? The other thing that you have to remember is if you're out there, say, rate shopping or car shopping or something that's going to provide you with an opportunity to have your credit report viewed a whole bunch of times for maybe the same goal, like I said, maybe to buy a car or obtain a mortgage. If those inquiry types are, focused within a 30, sometimes a 14 to a 30-day time period, it's not going to be, so if you went and had 5 of them pulled, it's not going to be 25 points to your score. It's going to be sort of banded together so that there's really less of an impact in your credit score. Now, the one thing that we do see from our reading with what FICO provides for us is if someone has 6 inquiries or more on their credit report during the course of a year, say, they're pretty it could be an issue as far as maybe someone headed towards bankruptcy. And the reason is because they are very likely to be seeking a lifeline in that. So that's something that the credit score does look at that. So we got a question, Shirvan, from Pat Williams.
Yes. It
How
says,
long?
yeah, you go ahead. I'm sorry.
No, that's no worries. It says, how long does negative information remain on your credit report? We see, so it'll stay on there probably about, I would say 7 years, I think is the rule of thumb that we see. But what we also know about that is it ages off a little bit at a time. It's most negative to your score in the very beginning. And as you get further and further and further away from that reporting, that's when it tends to have less of an impact on your credit score. Now, the one thing that you have to remember about negative information on your credit report, there's a little term that they use out there was garbage in, garbage out. So sometimes that could be erroneous information. So credit fitness, keep an eye on your credit report. And if there's a negative item out there, it could be a mixed file, which does occur with the junior senior situation, or it could also be something that's just erroneously being misreported, which we'll talk about that in a little bit more. But it's a relatively short amount of time in the lifetime. It can be corrected if it isn't proper. So the best answer I can give you on this is be aware of what's on your credit report. That's the most
Well,
important thing.
and just a quick, let me just echo one point there. The negative information, depending on what the negative information is, whether it's a judgment, whether it's a collection, whether it's a charge off, that could be on there if it's not taken care of. And correct me if I'm wrong, 7 to 10 years, what does that window look like?
That's proper, the way you said, 7 to 10 years, because there's different, lumping in everything together. 7 to 10 years is the best answer that we could provide.
And that's if it's not taken care of.
That's correct. And just because it's there, the thing that's most important to recognize is because it's there doesn't mean it's right. It doesn't mean that it can't be handled and removed. So it's the longer period of time is really when it's not dealt with, to be honest with you, because you have to remember, like, the composition of a credit report is going to be trade lines. Everybody signs up for trade lines, whether it's a car loan, a home loan, whatever type of loan, credit card. No one signs up for negative information on their credit report. Negative information makes its way on a credit report as a hammer to try to get people to pay a bill. So there's often an opportunity to have that removed. It's not forever. That's the point I like to drive home in this process. Okay. Go to the next one. Okay. So we're going to go through a couple of what really impacts your credit score from a negative standpoint and what impacts it from a positive standpoint. So anything that's currently past due is going to be a big factor of as far as impacting your credit score. Recent lates, high balances on unsecured debt, credit cards. As I said before, that utilization, when that gets up there, we sometimes see people that have a utilization north of 50, 60, 70%. And when they get paid down, it obviously has a very positive impact on the credit score. Any public record information. The caveat with the public record information is unless it could be tied to that consumer, by name, by social security number, 3 factors, date of birth as well, it has to be taken off the credit report. So we don't see as much public record information as we used to. And it's really, it came down to the fact that people had common names and they couldn't tie these trade lines to those 3 factors. When they couldn't tie them to the 3 factors, it had a negative impact on a lot of people's credit reports. And quite honestly, in a good way, it was removed. And then the other part of it that has an impact is any lack of open trade. So if someone has a lack of any activity on their credit report, it's probably going to have a we see credit reports where there's no open trade, everything is paid off, everything is closed, and they don't have a score. So, and that can be corrected pretty easily too as well. If we go to the next slide, how are you going to improve your score? Okay. We're going to spend a little bit more time talking about the collections in a little bit. So they're part of this whole process, but the things that we want to look at is 20 to 30% of the utilization of the credit cards. Get your balances right around there. That's going to have a very positive impact on your score. We see a lot of people that their scores get punished because they have a one-time late. And if there's a one-time late on your credit report, and it's truly an error, there's a good chance that your credit grantor will remove that late. It could be as easy as missing the mail or whatever it may be. But if you're an honest and upright individual and you spend the time and talk to them about that, they'll probably deal with you in a positive way. Okay. Student loan payments. There's a lot of people with student loans right now, and student loan servicers that collect the payments every month. They don't often report deferment status in a proper way. That's going to have a bit of a negative impact on the credit score. So if we could get those types of things cleaned up, it's quite honestly, it's a very positive thing. And the last item I always like to point out to everybody is installment loans. So if you have an installment loan and you want to take that money and pay it off sooner, it's not going to help your credit score. You're probably better off taking that money that you're going to spend on an installment loan and maybe using it to reduce the balance on your credit card. That's the big positive impact on that. Okay. Can we move to the next one? Okay. So 100 million people in the United States have a Credit Karma account. It's a great, great tool. It creates a lot of confusion in the process where people sort of identify a credit score that they feel that they have, whereas the FICO score version 8 might be different. So, a couple of things to remember. Credit Karma, as I said, it's a great tool. It's probably the most superior tool that you could use for credit fitness, as I said before. A couple of differences, though. Credit Karma doesn't use Experian Credit File. It only uses Equifax, TransUnion, whereas the FICO report that the FICO score that we use in mortgage is scoring all three. You'll see the score factors on the screen. They're a little bit different, but the most important thing to remember is Credit Karma is going to score 30 points higher than FICO. Same credit file, same time. And the reason is that it's a different score model. So there's a lot of people that come in for mortgage applications. I talk to my lender clients quite often, and they'll pull a credit report and it'll be a 720, and the consumer will say, I'm a 750. And that could get a little bit confusing. But I know, for instance, dealing with Shirvan with all these years, he's very well versed in this process. He gets it. He's able to explain that away. And that's a big, big help for the consumer. Okay, let's go through. I just have like 2 more slides. Medical collections. So the information you see on there right now, it all changed yesterday. Okay. So the CFPB, which is the Consumer Finance Protection Bureau, came out and they said that they want medical collections to be removed from credit reports. I happen to agree with that. We would see in the past, Shirvan and I working together, that if you had a medical collection on your credit report, it could be reducing your credit score by as much as 100 points, which is a very, very significant amount, depending on how your credit score is. We also saw through the years that medical collection agencies would not remove a trade line on a paid medical collection, that was pretty bad too. So in 2022, the credit bureaus got together and they said no more paid medical collection debt on the credit report, which is very positive. And then later in 2022, they said that a collection agency needs to give a consumer 6 months to straighten out their account before it starts to get reported. And then the other thing that they did is they said that you have to have at least a $500 balance with the collection agency before it could get reported to the credit report. So what happened now? So CFPB said no more medical collections on credit reports. It's probably going to happen towards the end of this year. It's very positive. In the information that CFPB put together, they said 20 points is what they felt the score difference was going to be. Shirvan and I know it's different. It's going to be a lot more. It could be as much as 100 points. So, and the only way we'll be able to see the total impact of someone is if we're fortunate enough to work with someone that starts out in that process with a medical collection account on their credit report, and then they get to see it removed. They could actually feel the impact. Like I said, we see unpaid, probably about 100 points. Paid that used to be on there, it was at least 50 points. Being removed altogether, very, very positive impact. So watch the news on that. I know the CFPB came out with that just yesterday.
Yeah, yesterday. Just for folks that don't know, and I would like to think everyone out there knows, but you can't assume anything. The
Sure.
CFPB is Consumer Financial Protection Board. So just in case, because we'll use acronyms because we know what they are, and we're assuming that because that's how they go. I mean, whatever the news reports, it is CFPB did this today. So in case you're wondering, what is the CFPB? It's the Consumer Financial Protection Board. But that's big news for customers. That is huge because the better your credit, the better the interest rate. The better the interest rate, the lower your payments.
So we got a question here from Lenora House. Okay, so Lenora's question is, are all credit reporting agencies required to remove medical debt from your report? Not yet. They're required to remove all paid medical collection right now. They can't report, the collection agency is not allowed to report a medical collection account, if you would, on your credit report unless the balance is $500 right now. And there's also a 6-month waiting period. So hopefully by the end of this year, if this all gets approved by the CFP, the Consumer Financial Protection Bureau, they'll be off the credit reports, which is going to be a big, big deal, as Shirvan just said. So we're pretty excited about that. We just got to wait for it to make its way through the channels and hopefully come off the credit reports, like they said, in a timely fashion and help people that need help in that spot. Okay. one more slide. Well, actually, two. This one, there's some changes that are going on with the credit reports. It's going to change in 2025. The long and the short of it is Fannie Mae and Freddie Mac, who are the big investors of mortgages in the United States, are going to start accepting credit reports based on two bureaus. And then they're also going to look at a different score model, but with additional score models for the consumer. That's not that much to worry about right now, because at most it's probably close to, I don't know what, 12, 15 months away. So we don't really like to spend a lot of time on that. We like to create awareness and let people know. And then my last slide just has the information on how to get in touch with the credit bureaus, their websites, annualcreditreport.com, which is a free credit report that everybody in America has access to once a week. It's a pretty neat process. Just bear in mind, if you go and you want to obtain your credit report, you're going to get a couple of challenge questions that only you should know the answer to, such as what was your car payment with ABC Bank in 2015? It's really to ferret out fraud. And the last item is really all about fraud. If you go to optoutprescreen.com and enter into that process, within 5 days, you will be removed from a process that's called a trigger, which will protect your privacy. You won't have to deal with triggers anymore. And you won't get the pre-approved offers of credit in the mail every day that tend to come from the credit card companies. I could tell you right now, from all the years I've been in this business, most people that have issues with identity theft, it all starts at their mailbox. There might be a pre-approved offer of credit for a credit card company. Someone grabs it, applies for credit in your name, and before you know it, your identity has been pinched. So you want to spend time on annualcreditreport.com to get a copy of your credit report, and opt out pre-screen to just make these bad things go away. Sure, that's all I have for today.
All right, well done as usual. You're just amazing at this stuff. And if there's any questions whatsoever, whether it's regarding credit, credit score, and so forth, please ask as we go along. We're not waiting to do a Q&A after. We'll do that as well. However, we take questions because I don't want anyone leaving with any unanswered questions. So again, Sean is amazing at what he does. Anything you do with regards to your credit score is critical, whether you're purchasing a house, whether you're purchasing a car, whether you're trying to achieve credit cards. You want to make sure that your credit is in order, and the higher your credit score, the lower your interest rate. And that is applicable whether it's for a house, car, credit cards, any loans whatsoever. It's dictated by your credit score. And I don't think that people understand the urgency that is needed to focus in on your score. That's a really great way of saving a heck of a lot of more dollars than you would normally think. That's where you save the money, is with your credit being in great shape. So anyway, as I told you guys before, I'm going to start with the Mortgage 101. And I'm going to run through this, but if you have any questions as we go, it covers just about anything. Before we start the process, though, let me just state one more thing with regards to credit. When you come to see me, if you have a credit issue, we could pull what is called a credit simulator. And it's a simulation of the three bureaus. So if your score is lower than the qualifying, which for us it's around 600, preferably they would like 620, and some grant programs for the state of Maryland or even DC look at 640. So if you need to increase your score, we will print out at least I will send you a simulation of the three bureaus with the negative or adverse credit on those bureaus. And it will tell you exactly what you need to do and tell you how much it will cost you for each individual creditor. Now, it'll only tell you what it cost you based on the credit report. I would suggest that if you have any adverse credit, like a charge off or collection on your credit report, that you contact the creditor or the collection agency and see if you could negotiate by paying 50 cents on the dollar and get a settlement in full letter. Okay, you could go payment in full and pay the whole thing. So if you have $1,000 debt and it's a charge off, more than likely the collection agency, if you say, hey, I'll give you $600 right now, I could write you either a check or I could just do my credit card or whatever mechanism or instrument you use to pay it. And you said if you give them a letter for settlement in full, stating the account number and the amount it was settled for, was settled with, and it has your name on it on their letterhead, we could use that and we could get your credit report updated by using that, saving you some money and paying that back so you could pay other debts if you have to. Just a note, and if you need any more on that, you're welcome to call me. More than happy to discuss that with you. Next slide, please. So why choose us? Well, first of all, Town Bank Mortgage is our parent company. I'm with FitzGerald Financial Group, which is a division of Town Bank Mortgage. Town Bank Mortgage, out of 5,000 banks in the country, Town Bank is recognized as in the top 15 banks in the country. We're out of Virginia Beach, Virginia, the biggest bank in the state of Virginia. And we are well known. Obviously, if you're ranked 16th out of about 5,000, you're doing something really good and your integrity is high. So it's a very big, that's why I'm very big on accuracy. It's very important that all customers, consumers, anybody listening to this right now receive accurate information that will assist them. We have loans that will be tailored to you. You also have personalized service. You have a concierge who is one of the best in the business. That's me. Competitive rates. So when I talk to you about rates, we have just about every program and we have rates, and we're pretty aggressive as far as rates are concerned. Actually, we're known for closing on time and closing loans in as little as 10 days, which is about the maximum amount of time you could close a loan legally, is in about 10 days, which I've done with my team. I have a great team and they'll put you in position to close very quickly. Next slide, please. So if you're thinking about buying a home next, you have the rent option or own option. With renting, which you're probably currently doing now, you have no control over your rent increases. You know for a fact that your rent is going to go up on an annual basis. You have no tax deductions with your rent. You have no privacy. You're limited to and to no ability to personalize your space. In other words, you know that once you turn in that apartment or house, you have to leave it the way you found it. So you can't go poking holes and painting it all sorts of colors, which you might prefer. You have to leave everything the way the seller wants it. And more importantly, and I think this is something that I always tell folks, you're paying somebody else's mortgage. You're not paying your mortgage. You're creating their security, not yours. When you own, you build your own equity. You build your own security. You claim a tax deduction. There's zero down payment options available, which I'll speak about going forward a little further into the presentation. You could customize your home, and there are fixed payment options. Now, from my standpoint, I'll be honest with you, I only do fixed payment options. I don't believe in adjustable rates. Even for those that are well-versed in mortgages, I have to look at your situation and know that you can handle it, because the fixed rate is the way that you know what you're expecting, a variable rate, an adjustable rate, I think that you have to be well suited and well versed in mortgages and have experience with mortgages to be able to go there. Next slide, please. So you're ready to buy a home and you ask yourself these questions. Do you have steady income? Do you pay your bills on time? Do you have low to medium debt? Do you have any money in your savings? Do you have the ability to make the mortgage payments? Do you have okay to good credit? Next. The importance of getting pre-qualified, and that's where all those questions will be answered. The most critical aspect of purchasing a home in this market, in any market, in a great market, is knowing what you qualify for, what your circumstances, and what the numbers look like. So you'll have a realistic pursuit of properties. In other words, you're not sitting there in front of shopping at Saks when you know you could afford Marshalls, or vice versa. I've seen people come into and say, hey, I know I could only afford it $300,000, and by the time we do the numbers, they could afford $500,000. I've seen people come in looking to buy $500,000 as well, and conversely, they could only afford $300,000. So that's a critical aspect of knowing what your buying power is. You have to understand the difference between what you qualify for and what you could really afford. And the way you do that is a budget. You have to create a budget for yourself once you see what the numbers are, because we know that there's those other debts that you might have that might not show up on my chart. Understand the loan programs and how to use them to leverage your purchase. Review your credit for accuracy beforehand. As Sean just said, the best thing you could do from a credit fitness standpoint is to check your credit and see where everything is, because there could be mistakes or there could be something that was an oversight that you didn't see. So you could obtain a yes or when answer to your application. Next, please. Next. So the qualifying factors for the 4 C's: capacity, credit, capital, and collateral. Income, capacity to repay the debt based on your earnings, your employment, your history, expenses, number of dependents, etc. Credit, history of how much you owe, how often you borrow, if you pay your bills on time, and if you're living within your means. Assets is capital, or the amount of cash you have for a down payment and settlement costs, as well as cash reserves to deal with repair, replacement expenses. Now, there might not be repairs, there might not be expenses after the fact, but most underwriters that are approving your loan want to know that you have a little reserve left over after you've paid your down payment and closing costs. Property, collateral to protect the lender's investment if you want to repay your loan. The home you buy must be worth enough, and that's to back your loan. That's where the appraisal comes in. When we get the appraisal will tell us that the property you're buying is worth what the seller says is selling it at, or what they stated it is. Next, please. So what factors affect your monthly payment? Next. So rates are, you always ask your lender for their current interest rates. So rates are very volatile, particularly in this market. You know that the Fed just met yesterday, and the Fed said, hey, we're not going to raise rates right now, even though inflation is ticked down and we've had a great jobs report. It's still, inflation is still a little volatile. It's still a little leery. And we're looking at a rate cut probably in the third quarter, which is around fall. And that will also bring rates down. However, you ask the lender when you can lock in a rate. Most rates when you come in is dictated, as I said before, by your credit score. And we will discuss rates with you. We'll give you an understanding of what the rates are. However, you can't really lock into a rate until you have a ratified contract. And a ratified contract is when you and the seller have agreed that you're going to purchase the house, they're going to sell it, and you sign on the dotted line, and then we'll be able to engage in locking you in. Make sure your lock on your interest rate is locked in until the day you close. In other words, if they give you a 15-day lock and they're going to take 30 to 45 days to process your loan, then your lock is going to expire, and then it's going to cost you probably more, depending on where the market goes, that you would have to relock and so forth. So it helps to have a credible loan officer that he or she knows what they're doing and has your best interest at heart. So if we know that the seller is willing to close in 15 days and that the loan officer can get you closed in 15 days, then 15 days is adequate. However, if you know that it might be a 30-day window and the contract states that, then it'll be in your best interest to have a 30-day window or 30-day lock. So origination points or discount points are fees paid to the lender for the loan or can be linked to the interest rate. Usually, the more discount points you pay, the lower the rate. Now, just to give you some insight, unless you're getting a loan that is charged points because of the rate, I exclusively, and I'm looking into the camera to look at you to say, I am a 0-point loan officer, because the points that you could use to get that rate, that's your choice, but it won't be mandatory by us unless you're doing an investment loan or something like that. But if it's a primary loan and you're looking to occupy that house, more than likely there will be a 0-point rate that I will offer you, so you don't have to go into your pocket for extra funds. That money could be used towards paying your closing costs and helping you get into the house. Next, please.
Shirvan,
Yes, sir.
we have a question from Pat Williams.
Okay.
It says, are there still loan options for the self-employed?
Absolutely. We do self-employed, and my team does self-employed loans all the time. Self-employed loans, the only thing that's really required and is different, so often people look at, oh my God, it's a self-employed loan, and they get people in an uproar over nothing. We just need 2 years tax returns and a year-to-date profit and loss. And the tax returns has to be the same returns that are filed with IRS, because every lender in the industry is going to verify that the tax returns that IRS has is the same ones that we have. So as long as you have 2 years tax returns, you're in great shape. And then we could go from there, because we're going to look at the income based on your tax returns, because that'll tell us whether or not you wrote off a lot of your income or you didn't write off, and it'll tell us exactly how much income we could use based on those 2 years. And the year-to-date profit and loss is just going to help us from an underwriting standpoint determine if you're on the same path. It doesn't really project, but if you're projecting that you're making about the same amount or a little bit more, I think it'll add comfort to an underwriter. Hopefully that answers your question, Pat. Next, please. Oh, I'm sorry, go back one. Down payment. Look, too often, and we still hear this, and I heard that Sean said myths or misnomers earlier when he was doing his presentation. Here's a myth. Not all houses require, or programs require 20% down. The only time you put 20% down is when you're looking to eliminate mortgage insurance. That's mandatory on any loan that doesn't have 20% down. So you could put 5% down, 10% down, 15%, 20% on a conventional loan. However, government loans, such as FHA or rural housing, you don't need to worry about that. The FHA loan is 3.5% down. Rural housing, and I told you we'll talk about 100% loans. That's one of them. Rural housing is 100%. And rural housing is known as USDA, a great instrument, and it's not talked about enough, but it's a great instrument if you don't want to live right in the city. So look, if you're around the Beltway and you live a little bit on the outlying areas in a rural area, then you'll probably qualify for USDA. I'll get to that in a second. Next slide, please. Next slide, please. So which mortgage is right for you? Next. So conventional loan, as we discussed, you could have a 3% down loan, 5%, 10%, 15%, but all of those will have mortgage insurance. And mortgage insurance protects the lender against anything happening to the property, unless you put down 20%, and that eliminates that fee. However, you could, if you don't have 20%, it's okay. You'll have the mortgage insurance, but you'll have to put down 3%, 5%, 10%, etc. Now, FHA, which for most first-time home buyers is the best option, in my opinion. It gives you latitude from a credit standpoint. It's a 3.5% down payment. It's a government loan, and it's a better rate by about 0.75% than conventional. And conventional is considered Fannie Mae and Freddie Mac. FHA is just the Federal Home Administration loan. Okay, USDA is the rural program I spoke to you about, and that has to be, the house has to be qualified USDA. So the realtor would know if it's a USDA house. Again, it's not going to be right in the proximity of the inner city. It'll be right on the outlying areas going into a rural, leaving the county or a little further out. But with the USDA, they'll either know, or you could call me and I could look up the address and tell you if it's USDA approved or not. Keep in mind, it's not a subdivision. So if you're around the DC Beltway, for instance, it could be in Accokeek, it could be in outside of Fort Washington, it could be in Malton, it could be in Brandywine. If you're in the Baltimore area, it could be in the outskirts of Ellicott City, it could be in the outskirts of Baltimore. So you have to find out exactly where it is, but they would know. Your agent will know. That's 100% down, 100% loan, no money down. So you could actually just have money for closing if you were to purchase one of those programs. It's important you have good credit there. There's really no flexibility there. So and good income debt ratios, that your housing, your income to your housing expense, your income to your housing and debt expense is right on point. The VA loan, if you served your country, you know you're eligible for this. It's only two true 100% loans. USDA and VA are the only two true 100% loans. Keep that in mind. And 100% VA loan, to me, it's the best loan that there is. If you're a veteran, you use your eligibility and get a house. And you can sell that house down the road and reuse your eligibility again. I am a veteran. I'm a Marine Corps veteran, so I do a ton of VA loans, and I'm here to tell you that you could do that, and you could buy a house up to $1 million with a VA loan. And no money down. That's where we've come. I remember back when it was, a couple $100,000. Now we're at that point. And then there's the renovation loan. And renovation loans are, and this is just my expertise, and my feeling, I think you have to be experienced to get the renovation loan and the rehab loan, because it's a very tedious process, and that's one you'll have to call me and discuss if you were interested in that. But that's a bit much for someone that's a first-time home buyer. But if you're a seasoned homeowner and you're ready to move up to something like that, a rehab renovation loan, I'll be more than happy to assist you. Next slide, please. So we went over the conventional. Next slide. We went over the FHA. Next slide. And VA loan. And I'm not getting into the qualifying aspects of this because I would rather get into, once I see your credit, once I see your numbers, I could tell you firsthand if you qualify. USDA loan, we went over. Next slide. So there are grant funds and down payment assistance programs around the Beltway. And next slide, please. The Maryland Mortgage Program, probably, in my opinion, one of the best programs for first-time home buyers and qualified buyers. My favorite program, that's why it's on here. They have a multitude of programs with MMP, which is Maryland Mortgage Program. You could get a program where, into this program, where they, if you qualify, 3%, 4%, 5% towards your closing costs. That's a grant program. The funds, if the funds exceed your down payment and closing costs, then the remainder could be applied to your principal, but they won't, because you could get 4%, 5%. Keep in mind that from 3% to 4%, 5%, the rate will go up each time. So just a note that if you want to get 4%, 5%, that's fine, but there's different parameters on each. But I've done all of these, and they work great. But, and I have to say but, and use the however word, if you're using this program, the rate is going to be higher by about 3/4 of a point. In other words, instead of 6 3/4, it might be 7.5%. So I might be able to give you 6.5% without the program, but with the program, since they're offering you 3, 4, 5%, they offer a rate of maybe 7.5%. And I'm just saying, whatever it is, it'll be 0.75% higher than what the rate is that we would give you. So great program. And again, I will be able to tell you once I see your credit, once we see what your qualifications are, if you qualify for that program. Next slide, please. And they also have one which is a first-time advantage with $6,000. But if you look up at the 6,000, it's going to be less than the 4% or 5%, which, depending on the sales price, could go up to about 11,000, 10,000, 9,000, depending on the sales price. Next. And then there's a Home Start 6% down payment assistance to help with student loans and stuff. And again, this gets a little bit too much trying to do this here, so we're going to skip through these and skip. DC Open Doors has a program for the District of Columbia, 0 down payment. By the way, let me just backtrack. I said Maryland Mortgage Program. That's for the entire state of Maryland. So whether you're in Baltimore, whether you're in Prince George's, whether you're in Carroll County, whether you're in Charles County, wherever you are in Maryland, that program, MMP, is applicable to you. DC Open Doors is exclusive to DC, and we always have to check to make sure it's available. But as you see, it says 0 down payment, but it's up to 100% financing. It's a little different because of the grant that's involved. It's not a true 100%. Next, please. FHLB is the first-time home buyers program. It's the Federal Home Loan Bank of Atlanta. Actually, we have funds now, but it goes fast. I'm not sure it'll survive the weekend. They give us funds twice a year for with the amount of 500,000 for the first half, 500,000 for the second half. However, you could see up to 12,500 assistance for closing costs, and I think that's been increased to 15K. I'm not sure, but the borrower has to contribute at least $1,000 to that process, and you have to qualify. Those guidelines are very tight, more tight than the MMP. That's why more people, I think, go to the MMP, and they give you, I think it's up to 17.5 now, and I will have to look for the community partners, police officers, firefighters, state employees, accredited schools, teachers, etc., military members, and so forth. But again, that money goes fast, and I am pretty sure that we're on the verge of losing that altogether for the year. Next slide, please. Virginia Housing, skip. Virginia Housing, skip. Skip, please. Student loans. Used to be a big deal on student loans that you used to have to just go with 1% of the student loan balance, which will kill just about anybody qualifying for a mortgage. Just imagine this, $100,000 in student loans, and you have to go with 1%. That's $1,000. And if it was 200,000, etc. So now the great news is that it's at 1.5, and that's in the last few years. So 0.5%. So it's like a 0.5% of the loan balance we could use to qualify you. Now, keep this in mind. Just because you're deferred on a student loan doesn't mean that you're exempt from a payment. We still have to apply a payment on your qualifying with the student loan. Your credit report will say deferred, right? But we have to put 0.5 to whatever your balance is and use that payment, because eventually you'll have a payment and they want you to have that. That's from the student loan entity and HUD, Fannie Mae, Freddie Mac. That's just across the board. The great news is that now we could use income-based repayment plans are acceptable. So the income-based programs is based on your income, and instead of there was 0.5%, that income-based program could give you payments like $50 or $10 or $15. But instead of, if your credit report says you're deferred or you have a different payment, we have to go by your credit report. If you have something with the income-based repayment plan, you have to give us something in writing on student loan letterhead stating the agreement and the payment. If you have that documentation, you're in great shape. Then we just use that information and we qualify you. Obviously, you'll qualify for more with using that rather than using 0.50. Next, please. And that is applicable to VA loans, conventional loans, and USDA loans as well. Next, please. All right, so this is about the credit scores, and you just had the best in the business just go over everything credit with you. That's why I don't do the credit, even though I can. I know it, but I rely on Sean's expertise because he also brings some other stuff like the opt-out and gives you really good presentation on the scores. Next, please. Next. And next. Next. Oh, no, back one, please. This is just highlighting. I'm not going to get into too much here, but this just gives you a good snapshot of what $350,000 loan amount. Look at the score. Now, the rates aren't 5% or 4.5% in this time period. That's some time ago. This is just an example to give you the difference. A 679 score, which is considered a pretty okay score, okay, will give you 5%. Here's the difference. 720 score, which is an excellent score, is giving you 4.5%. Look at the difference in your principal and interest payment. That's how every mortgage payment starts out. Principal and interest, 1879 to 1774. That's $100 and something right there. Okay, that just gives you a difference on how important your credit score is and how it makes such a stark difference. Just imagine if you went up to an 800 score, what the difference would be. And imagine if that 679 is 630 or 620, what the difference would be. That will still push it up. So credit is incredibly important. Next, please. Next. So these are the do's, the don'ts. I'm sorry. I come to the conclusion. I know this is one of Sean's favorite parts, because the don'ts capsulizes everything you shouldn't do when you're looking to purchase a home. And this is my last slide, so please pay attention. Number one, do not change jobs, become self-employed, or quit your job while you're in the process. Now, it doesn't mean that you can't get a job for better pay, because if that is what's happening, I will tell you, go for it. But this is what we'll need. We'll need pay stubs showing that you've gone to a new job. We'll need your offer letter, but we will need your first pay stub. And sometimes, depending on the type of loan you have, you might need two. So you can do that, but know that we might need some documentation. But no one's going to tell you not to take a better position that's better paying. But don't quit your job, because then you can't afford to pay the house. So that's where that comes from. Do not buy a car, truck, or van. It is critical. You don't want to have a beautiful car, beautiful truck, because guess what? You could wind up living in it. It's not the house that you want. You want that get the house first, put the car in the driveway second. But know that you qualified for your house and you qualified for the car. If you try to get the car, truck, or van first, I have to use, or any loan officer has to use, that huge payment that comes with that car, truck, or van to qualify you, and you might not qualify. So please pay attention. Number three, do not use charge cards excessively or let your accounts fall behind. Just because we pulled your credit and everything's hunky-dory doesn't mean that they're not going to pull a soft pull right before closing to make sure that you haven't added any debts. Do not charge. I've seen people do that and then they wind up not qualifying. Okay? If I'm getting you closed in about 2 weeks, I think you could hold off. Do not spend money you have set aside for closing. Do not take the trip to Cabo or Cancun and have a great time for 4 days and squander all the money that you've, worked your butt off to save for your house. Okay. Number five, do not omit debts or liabilities from your loan application. We're going to find out anyway. Soft pull. Underwriters have a lot of different software instruments they use to find out about the consumer than you think. So don't do that to yourself. Do not buy furniture. Another big ticket item that you could wait until you have the house and buy your furniture. Do not originate any inquiries on your credit card. Any inquiry that you originate on your credit report, we have to have an explanation. And then if there's a credit card that goes with it, we need a statement to see how much you charged up and how much you owe. Do not make large deposits without first checking with your loan officer. Every large deposit is $500. Any large deposit in excess of $500 has to be explained and documented. So don't move any funds or deposit any large amounts that you don't have documentation for. Number 9, do not change bank accounts, or move money between accounts. Keep all your bank statements. You don't need to move anything. We're perfectly capable of just looking at it and making the adjustment on the statements. But we don't need money coming from someplace that we don't have statements for, because then you'll be required to give us the statements. And lastly, do not co-sign a loan for anyone. And I know that we all have the relatives that know you're doing well and you save money and your credit's good, and they're going to come to you, hey, why don't you co-sign this car for me? But that puts you in the lurch, because you won't be able to purchase your home. This is where you just a little bit selfish and say, no, let me take care of my house. And I'm not a big fan of co-signing for folks anyway, but take care of your house first, get in the house, and then you could look at assessing whether or not you're in position to do that. Next slide, please. And this is my contact information. If you need to contact me, 571-278-8351 is my cell phone, and my email address is shirvan.joseph@fitzgeraldfinancial.net, and my website is on there as well. You're welcome to go on the website, fill out a loan application, and I will get back to you as soon as I receive the completion notification that is an application in the portal. I could then contact you and let you know, based on what I've assessed on your qualifications, this is where you are. I thank you guys for participating in our presentation this evening. I hope you give us a call, give me a call. If you have any questions whatsoever, whether it's regarding credit, whether it's regarding mortgage, be more than happy to assist you in any way I can. Sean?
Thanks, Shirvan. As always, very informative. I like the don'ts, especially about being selfish or maybe ended up living in the car, but spoken like a true pro. I appreciate the opportunity to participate.
And I do too. Thank you guys for participating again. Look forward to seeing you next time.
Have a great night.